Have you ever wondered how businesses decide the price of their products or services? The secret lies in cost accounting. Welcome to the fascinating world of cost accounting, the backbone of every successful business. But what exactly is cost accounting and why is it so important? In simplest terms, cost accounting is a process, a methodical way of recording, classifying, and analyzing various expenditures incurred in the production of goods or services. The goal is to understand the total cost of production, which is not just the price of raw materials, but also includes labor, overheads, and other expenses that go into creating a product or service. By understanding these costs, businesses can make informed decisions about pricing, budgeting, and financial planning. It helps them identify where they can cut costs, where they need to invest more, and ultimately how to increase profitability. Now let's delve a bit deeper. In the realm of cost accounting, we use the term cost to represent the monetary value of resources used in the production of goods or rendering of services. This could be the cost of raw materials, the wages paid to workers, or the rent for the factory where the goods are produced. The need for cost accounting arises from the simple fact that to run a business effectively, one needs to control costs and maximize profit. It provides the necessary data for managerial decision-making and strategic planning, making it an indispensable tool in the business world. The objectives of cost accounting are manifold. It assists in determining the cost of a product, aids in cost control and cost reduction, and helps in ascertaining the profitability of each activity. It also assists in inventory valuation and in preparing budgets and forecasts. In essence, cost accounting is a business's compass, guiding it towards financial success. It's the tool that helps businesses navigate the complex seas of economic activity, helping them steer clear of financial icebergs and sail towards the shores of profitability. Cost accounting is the key to understanding the financial health of a business and making strategic decisions. So stay tuned as we delve further into this fascinating subject in our upcoming scenes. Let's delve deeper into the world of costing and cost accounting. First, let's talk about cost. In its simplest form, cost is the amount of money spent on a particular thing, whether it's the materials to make a product, the labor to assemble it, or the overheads to keep the factory running. These are all costs that businesses must consider. Next, we have costing. This is the process of determining the costs associated with a product or service. It's like a detective work where you track down every penny spent from the raw materials to the final packaging. It's not just about what you spend money on, but also how much of it you use. By understanding costing, businesses can make more informed decisions about pricing, budgeting, and profitability. Finally, we come to cost accounting. This is the method of analyzing, summarizing, and recording costs, with the aim of controlling expenditures and improving profitability. It's like the captain of a ship, steering the business away from unnecessary expenses and towards cost-effective strategies. Cost accounting provides the information needed to make strategic decisions about the business, such as which products to focus on, where to cut costs, and how to price products. While these three terms may seem similar, they each play a unique role. Cost is the fundamental building block, the raw data. Costing is the process of gathering and organizing this data, and cost accounting is the analysis and interpretation of this data, turning numbers into actionable insights. In other words, cost is the what, costing is the how, and cost accounting is the why. They're like three sides of the same triangle, each one supporting and reinforcing the others. So why is this important? Because understanding costs and how to manage them is crucial for the success of any business. It's like knowing the rules of the game. Only by understanding costs can businesses make informed decisions, maximize profits, and stay competitive in the marketplace. Understanding these three terms is the first step towards mastering cost accounting. How is cost accounting different from financial accounting? Let's find out. Financial accounting and cost accounting are two key branches in the field of accounting. While they might seem similar, they each serve distinct functions in a business. Here's how. Financial accounting focuses on recording, summarizing, and presenting a company's financial transactions. It's all about providing information to external parties, such as investors, creditors, and regulatory authorities. It's like a window through which outsiders can view the financial health of a company. On the flip side, cost accounting is primarily for internal use. It's the process of recording and analyzing all costs incurred in a business. It's like a mirror that reflects the cost efficiency of various business operations to the company's management. Now let's talk about the unique advantages of cost accounting. It helps in cost control and cost reduction, aids in decision making, and assists in setting selling prices. It's also a handy tool for performance evaluation and budget preparation. However, cost accounting isn't without its limitations. It can be complex and time-consuming. It might not always consider qualitative factors, and it's largely based on estimates rather than exact figures. But don't let these limitations undervalue the importance of cost accounting. It's like a compass guiding a ship. Without it, a business might lose its way in the vast ocean of operational costs. Cost accounting and financial accounting are like two sides of the same coin. They might seem similar, but they have distinct roles. Financial accounting looks at the big picture, presenting the overall financial health of a company to the outside world. Cost accounting, on the other hand, delves deeper into the details, providing valuable insights to the company's management for efficient cost control and profitability. So, while financial accounting paints the financial portrait of a company for its stakeholders, cost accounting provides the detailed sketch necessary for the management to make informed decisions. While financial accounting and cost accounting may seem similar, they each serve distinct functions in a business. Costs are not created equal. There are several types of costs to consider in cost accounting. So let's dive in and explore the classification of costs, which primarily include material costs, labor costs, and overheads. First off, material costs. These are the costs of all the materials which are directly involved in producing a product. For instance, if you're baking a cake, the cost of flour, sugar, and eggs would be your material costs. This is the basis of your product, the ingredients that make up what you're selling. Next up, we have labor costs. This is the cost of human effort in the production process. It includes wages, salaries, and other benefits provided to employees. Back to our cake baking example, the wages you pay to the baker would be your labor costs. It's important to note that labor costs are not just about the hourly wage or salary. They also include overtime, bonuses, and benefits. Lastly, we have overhead costs. Overheads are indirect costs that cannot be directly traced to a specific product. These include the cost of utilities, rent, and depreciation. In our cake baking scenario, the cost of electricity, rent for the bakery, and depreciation of baking equipment would be your overhead costs. They're like the invisible ingredients that keep your production process running smoothly. Each of these cost types plays a crucial role in cost accounting. Material costs help determine the direct cost of production. Labor costs, on the other hand, can show us how efficiently our human resources are being utilized. Overhead costs, although indirect, can give us insights into our operational efficiency. In a nutshell, understanding these costs allows businesses to make informed decisions about pricing, budgeting, and operational efficiency. By recognizing and categorizing costs accurately, they can better manage their resources, increase profitability, and achieve their financial goals. So, there you have it, a concise look at the classification of costs in cost accounting. Remember, recognizing and categorizing costs accurately is crucial in cost accounting. In the world of cost accounting, certain terminologies are used frequently. Embarking on this journey, let's first comprehend the term cost unit. It's a measure of quantity of the product or service in relation to which costs are ascertained. For instance, if you run a shoe factory, your cost unit could be a pair of shoes. Next, we have cost center. It's any location, person, or item of equipment for which costs may be ascertained and used for cost control. In our shoe factory, the production line could be a cost center. Moving on, we delve into direct costs. These are costs that can be directly attributed to a specific cost center or cost unit. The cost of leather in our shoe factory is a direct cost. On the contrary, indirect costs can't be directly attributed to a specific cost center or cost unit. The factory's electricity bill is an indirect cost because it can't be attributed directly to a single pair of shoes. We then have prime cost, which is the total of direct materials and direct labor cost. It's the initial cost of producing a product, excluding overheads. Production cost is the sum of the cost of raw materials, direct labor, and manufacturing overheads. So in our shoe factory, the production cost includes the cost of leather, workers' wages, and electricity. Administration cost refers to the costs associated with the general administration of an organization rather than its manufacturing or selling activities. This might include the salaries of executives or the cost of office supplies. Selling and distribution cost, as the name suggests, includes all costs associated with selling the product and getting it to the customer. This might include advertising costs or delivery charges. Fixed cost is a cost that does not change with the level of output. It remains constant regardless of the number of shoes produced in our factory. Variable cost, on the other hand, varies directly with the level of output. The more shoes we produce, the higher the variable cost. Semi-variable cost is a cost that has elements of both fixed and variable costs. It remains constant up to a certain level of output and then starts to vary. Period cost is a cost that is not directly tied to a product or production process. It's associated with a specific time period, such as a monthly rental payment. Product cost is the cost assigned to a product and includes direct materials, direct labor, and allocated overheads. Explicit cost is a direct payment made to others in the course of running a business, while implicit cost represents the opportunity cost of using resources in one way rather than another. Historical cost is the original cost of an asset, while current cost is the cost that would be incurred if the same asset were acquired in the current period. Future or predetermined cost is an estimated cost for a future period. Opportunity cost is the cost of forgoing the next best alternative. Mastering these terminologies will make your journey in cost accounting much smoother. Costs can also be classified based on their behavior or the period they relate to. Let's dive into the different types of costs and their relevance in cost accounting. Starting with fixed costs, these are expenses that remain constant regardless of the level of production or business activity. Examples might include rent or salaries of permanent staff. Variable costs, on the other hand, fluctuate with the level of production. If your business produces more, you'll also spend more. Costs such as raw materials or power consumption fall under this category. Semi-variable costs are a blend of fixed and variable costs. They remain constant up to a certain level of production, and beyond that, they start to increase. A typical example could be a cell phone bill, where there's a fixed monthly charge with additional costs for extra usage. Next, we have period costs. These costs are not directly tied to production, but are incurred over a certain period. Advertising costs or administrative expenses are good examples of period costs. Product costs, however, are directly associated with the production of goods or services. They include direct materials, direct labor, and manufacturing overheads. Moving on, explicit costs are the actual out-of-pocket expenses a business incurs. These are the costs that are physically paid out to others, like rent or wages. Implicit costs, on the other hand, represent the opportunity cost of using resources owned by the business. They are not actual cash expenditures, but represent the potential income that could have been generated if the resources were used differently. Historical costs refer to the original cost of an asset, while current costs represent the cost that would be incurred if the same asset were acquired in the current period. Future or predetermined costs are estimated costs expected to be incurred in the future. These are often used for budgeting and planning purposes. Last but not least, opportunity costs represent the potential benefits that a business misses out on when choosing one alternative over another. If you invest in Project A instead of Project B, the return from Project B represents the opportunity cost. Each type of cost has its relevance in cost accounting. Fixed and variable costs help in cost volume profit analysis. Period and product costs assist in pricing decisions. Explicit and implicit costs aid in evaluating the true profitability of a business. Historical, current, and future costs are crucial in budgeting and decision-making, while opportunity cost plays a vital role in strategic decisions. Understanding these types of costs is fundamental in cost accounting. Implementing a cost accounting system can be challenging but rewarding. It's like assembling a puzzle, each piece representing a different aspect of your business's financial picture. Let's start by looking at the features of a good cost accounting system. First and foremost, it must be comprehensive, encompassing every cost incurred by the business, from material and labor costs to overheads and administrative costs. Next, it needs to be accurate. Inaccurate cost data can lead to misguided decision-making, so precision is paramount. Moreover, the system should be flexible, able to adapt and evolve with the changing needs of the business. It should be simple enough to be understood by all relevant stakeholders, yet sophisticated to capture all necessary details. And of course, it must be cost-effective. The benefits gained from the system should outweigh its costs. It's like investing in a high-quality tool. It might be pricier upfront, but it pays off in the long run through efficiency and effectiveness. Now, on to the precautions to take when installing an effective system. One of the most critical is ensuring the system aligns with the company's objectives. A mismatch here can lead to a system that doesn't deliver the desired results. Next, involve the relevant stakeholders, from top management to the employees who will use the system daily. Their input is invaluable in designing a system that meets everyone's needs. Training is another crucial element. Users need to understand the system thoroughly to extract maximum value from it. So, invest in comprehensive training programs to ensure everyone is on the same page. Finally, remember that installing a cost accounting system isn't a one-time event, but an ongoing process. It needs regular maintenance and updates to stay relevant and effective. Now let's talk about potential challenges. First, resistance to change can be a significant hurdle. People tend to stick to familiar routines, and a new system can disrupt that comfort. Hence, it's crucial to communicate the benefits of the system clearly and provide ample support during the transition. Another challenge is the complexity of the system. If it's too complex, it can be hard to use and understand, leading to errors and inefficiencies. On the other hand, if it's too simple, it might not capture all necessary data. Finding the right balance is key. Lastly, the cost of implementing the system can be a challenge. This includes not only the cost of the system itself, but also the cost of training, maintenance, and potential disruptions during the transition. However, remember that this is an investment that, if done right, can yield significant returns in the long run. In conclusion, while installing a cost accounting system may seem daunting, it's an investment that can dramatically improve your business's financial management. With the right features, precautions, and an understanding of potential challenges, you can navigate this process successfully. And the reward? A well-designed cost accounting system can significantly improve a business's financial management. Let's recap what we've learned about cost accounting. We've journeyed through the intricate world of cost accounting, a specialty within the broader field of accounting that focuses on capturing a company's total cost of production by assessing the input costs of each step of production along with fixed costs, such as depreciation of capital equipment. We started by distinguishing between costing, and cost accounting. Cost is the monetary valuation of the effort, material, and other items used up in production. Costing is the process of ascertaining costs, while cost accounting involves the process of recording, classifying, analyzing, summarizing, and allocating costs associated with a process, and then developing plans and controls for these costs. We then compared financial accounting and cost accounting, highlighting that while financial accounting is concerned with reporting financial information to external parties, cost accounting is used internally to help management make informed decisions. Our exploration led us to the classification of costs, which we divided into material cost, labor cost, and overheads. Each of these classifications represents a different aspect of the total cost of a product or service. We also covered important terminologies that are integral in the world of cost accounting. Terms like cost unit, cost center, direct cost, indirect cost, prime cost, production cost, and many more, each having their unique roles and meanings in the cost accounting process. We also delved into the different types of costs, such as fixed, variable, semi-variable, and opportunity costs, among others. Understanding these various types of costs is vital for effective cost control and strategic decision-making. Lastly, we discussed the installation of a cost accounting system. We highlighted the features of a good cost accounting system and the precautions to take when installing an effective one, as well as the challenges that might arise in the process. With a solid understanding of cost accounting, you're now equipped to make informed financial decisions in business.